Imagine waking up one morning to headlines claiming the United States is once again talking seriously about acquiring Greenland. Not leasing a base, not signing a mining deal, but outright acquisition. It sounds absurd, almost like a meme revived from 2019. Yet beneath the jokes sits a much more serious question. If something like this ever happened, what would it actually mean for the global economy, the US dollar system, and the balance of economic power in the 21st century? Greenland is often framed as a frozen wasteland, a geopolitical curiosity with more ice than people. Economically, that framing is outdated. Greenland sits on top of vast reserves of rare earth elements, critical minerals, uranium, and potentially oil and gas. These resources are increasingly central to modern economies built on electrification, semiconductors, batteries, and military technology. In a world where supply chains are no longer trusted, and economic security is treated as national security, control over raw materials is no longer optional. It is strategic. If the United States were to acquire Greenland, the immediate economic impact would not come from tourism or fishing or even oil production. The first-order effect would be psychological and financial. Markets would immediately interpret the move as a signal that the U.S. is shifting from a purely financial empire to a resource-backed one, prioritizing physical control over inputs, rather than relying on global trade assumptions that are clearly breaking down. That signal alone would ripple through commodity markets, defense stocks, infrastructure plays, and currencies. One of the biggest implications would be rare earths. Today, China dominates rare earth processing and to a large extent, rare earth supply. These materials are essential for smartphones, electric vehicles, wind turbines, missiles, radar systems, and advanced electronics. The United States has spent years talking about reducing dependence on China. Progress has been slow because mining and processing are expensive, politically messy, and environmentally controversial. Greenland changes that equation. Under U.S. control, Greenland would offer a long-term strategic alternative to Chinese dominance, even if actual production takes years to ramp up. Markets price futures, not present reality. The expectation of future supply shifts alone would be enough to alter investment flows. Mining equities tied to Greenland would surge. Competing projects elsewhere might reprice downward. Chinese leverage over supply chains would be perceived as weakening. Beyond minerals, Greenland's geographic position matters economically in ways most people overlook. As Arctic ice melts, new shipping routes are opening that dramatically shorten transit times between Asia, Europe, and North America. Control over Greenland means influence over Arctic logistics, undersea cables, satellite infrastructure, and future shipping lanes. In economic terms, that translates into control over trade efficiency, insurance cost, and strategic choke points. For the U.S. economy specifically, acquiring Greenland would signal a renewed emphasis on industrial policy and long-term strategic investment rather than short-term financial optimization. This aligns closely with Trump's broader economic worldview, which favors tangible assets, domestic production, and leverage over global systems. Markets would likely interpret this as confirmation that the era of frictionless globalization is not returning. There would also be fiscal implications. Acquiring Greenland would not be cheap, not just in purchase price but in infrastructure, development, defense, and subsidies. The U.S. would likely invest heavily in ports, roads, energy systems, housing, and military installations. In the short term, that means higher government spending, which could be inflationary if funded through debt. Defense contractors, construction firms, and energy companies would benefit disproportionately. At the same time, such spending could be framed as investment rather than consumption. Unlike temporary stimulus programs, infrastructure tied to strategic resources has long-term economic returns. Bond markets would care deeply about that distinction. If investors believe Greenland strengthens America's future productive capacity, the impact on yields and the dollar could be neutral or even positive. This brings us to the dollar itself. The dollar's dominance rests not only on trust and military power, but on control over global trade and resource flows. If the U.S. begins securing physical resources instead of relying purely on financial leverage, it subtly reinforces the dollar's role as a settlement currency for real goods. In a world questioning dollar dependence, this could stabilize demand rather than weaken it. The flip side is Europe. Denmark and the EU would view such a move as a direct challenge to their sovereignty and influence. Economic retaliation, regulatory pushback, and trade friction would be likely. These frictions would raise costs and contribute to structural inflation over time. China's response would be even more consequential. Beijing would likely interpret a Greenland acquisition as an escalation in the resource war. China would accelerate efforts to secure resources in Africa, Latin America, and Central Asia. That competition would drive up raw material prices globally. Producers would benefit. Consumers would not. There is also the question of energy. Even the possibility of future Arctic oil and gas production under U.S. control would affect long-term energy expectations. Energy markets respond to future narratives, not current output. At the same time, environmental opposition and regulatory constraints would introduce political risk. For Greenland itself, the transformation would be profound. Capital inflows, infrastructure, and labor migration would dramatically alter its economy. GDP would rise, but so would inequality, environmental pressure, and social tension. Markets would price those risks carefully. For global investors, the biggest takeaway would not be Greenland itself, but what the move represents. A shift from a finance-heavy global order to an asset-heavy one. In that world, commodities, defense, infrastructure, and strategic technology outperform. This fits a historical pattern. Great powers acquire territory not for prestige, but for leverage and future optionality. The Louisiana Purchase and Alaska were mocked at the time. Their long-term economic value far exceeded their cost. Markets remember that. Even if acquisition never happens, negotiations alone would shift expectations. Volatility would rise. Risk premiums would adjust. Strategic assets would reprice. At its core, the Greenland idea highlights a deeper truth. The future economy is constrained by physical reality. Energy, minerals, geography, and logistics matter again. Greenland sits at the intersection of all four. As this transition deepens, the economic ripple effects grow larger. Supply chains regionalize. Prices grow more volatile. Strategic assets command premiums. Countries that secure inputs early gain flexibility later. Greenland becomes a symbol of this shift. If the U.S. pursue Greenland, domestic debates around mining and industrial policy would intensify. These debates matter economically because they determine speed. Delays mean higher prices and import dependence. Speed means resilience, but political cost. Labor markets would tighten. Engineers, geologists, construction workers, and defense personnel would be in higher demand. Wages would rise in key sectors. Inflation management would become harder. Globally, smaller nations would watch closely. If territorial acquisition becomes normalized, risk premiums rise everywhere. Shipping insurance, emerging market debt, and trade finance would all reprice. Historically, this feels familiar. Economic power once depended on territorial control. The post-war period temporarily broke that link. That link is now reforming. Even if Greenland remains Danish, the conversation alone forces investment. More infrastructure, more defense, more capital. The Arctic becomes a new economic frontier. Ultimately, the impact is not about GDP math. It is about regime change. A shift from abundance to scarcity management, from efficiency to resilience, from paper wealth to physical leverage. That is why markets would care. That is why commodities would move. That is why currencies would react. And that is why Greenland is not a joke. It is a signal, a preview of the economic world taking shape.